because they don't care anymore because they sold the company.
Thank you. Good morning, everyone. Do you want to answer that about Waypoint before we start?
We had no idea the other company existed. Our CEO named it because he's a boating guy, Waypoint, and that was it. And
But it doesn't matter, does it?
No, it hasn't. It hasn't, and hopefully it won't.
Yeah, because I think Starwood now owns Waypoint.
They did,
Yeah.
yep.
And hopefully Starwood would own you someday.
We'll see.
Okay. We're down the street in Stanford, so you never know.
That's right.
Thank you, everybody. I'm Adam Fruitbine, Head of Capital Markets here for Waypoint Residential, joined here today by my two colleagues, Kevin Clare and John Mooney, who are based out here on the West Coast as relationship managers. So we are a vertically integrated real estate operating company. We focus on the multifamily asset class, and we are owner, operators, we are developers. We pretty much buy, build, and manage our own properties across the U.S. Thanks. Thank you. We're based out of Stamford, Connecticut, and just to be clear here today, we're 7 years old. We've done about 2.4 billion of transactions over about roughly 79 deals. We're here to talk about investing in rental apartments with us. This is not necessarily a VC or angel discussion. We are up and running. We are profitable. We have revenues. In fact, we have plenty of bodies to run real estate. It's not a scalable business, but we'll talk a little about how we do what we do and why we like the sector. So from the start, vertically integrated. We have our own systems in place. We source our own business. We build our own projects. We own and manage. We'll buy core for current income. We'll buy 15 to 20-year-old value-add projects that we want to put money into and fix up with capital improvements and operational improvements, and we'll build new. The trick for us is we love the rental space. We think it's probably the place to be. It's the most liquid, and obviously people need a place to live, and we do it across the country. Specifically, we are mostly east of the Mississippi, but we're growing out west. We're doing that prudently. We have 6 execution offices: Florida, Texas, Georgia, Chicago, headquartered in Stanford. We have a mix of folks that are specialized from the institutional world. Really, the trick for us here is that we are all, in our own way, institutional professionals, and we have chosen to come together here, bring our expertise to the private investors. We think that's somewhat of a unique perspective, and it's one of the things that I think differentiates us. Is most importantly, we target 100% private investors to do business with. And part of that is really we think that our interests are aligned, particularly as we look at apartments for reasons discussed. Great current income, great fundamentals, and ultimately very low volatility. And we'll talk about some of the reasons we like it. So going forward here, 79 transactions in 7 years. We have a pretty deep bench, and we've also taken roughly 24 of those, and we've taken them full circle. Now, our hold period is typically 7, 8, 9, can be 10 years is how we look at the projections. But we've realized some great value, and we've taken a look at each deal. We're somewhat agnostic about the opportunity. And if we think that the profits are there, and it's a better day today to sell versus hold for the cash flow, we will, and we have. We've averaged about 22, 23% net returns to the investors on those sales. Now, it's a great number, but that's not necessarily how we underwrite. I want to sort of be clear about that. We're looking at core investments in the 7 to 8% range, looking at value-add investments in sort of the 9 to 12 or 13% range, and then developments higher, 14 to 17%. We've done well. Part of that is we're in a great asset class, and part of it is we really know what we're doing. Going forward, a quick couple of points about the value proposition. Leverage. Okay, we use leverage, but we use it extremely modestly. We go to the agencies, the Freddie, the Fannies, the commercial banks, the insurance companies. Liquidity in our space is very high. We could go much higher. We put 60, 65% debt on every project. Why? Because you don't need any more. And frankly, we'd rather have cash flow than pay debt service. And so basically what we're looking at is you need roughly 40 or 50% of your rent roll, the income, to cover your debt service. After that, the rest is going into operations or being distributed to investors. The way we see it, we underwrite for the downside. We underwrite for the next day that Lehman happens. The upside takes care of itself, and you're seeing it in the returns we have. So, one of the best things about the space is ultimately there's demand. We are picking locations in growth markets, in core markets, transitional assets. There's always a story about location. There's always a story about who's gonna rent there. The trick is to have a multiple in sort of the renter profile and the demand type. And that's why we stay full. The apartment class has done exceptionally well, the demographics are in our favor, and barriers to entry in some of the markets we're in are extremely favorable. Favorable tax treatment. When you invest as an LP, we'll talk a little bit more about how we can connect with you. Okay, you're going to be able to use depreciation to offset your taxes. You're going to be able to potentially defer capital appreciation through 1031s. A lot of the projects that we've sold, of those 24 we mentioned, 99% of the investors stay in, and we go through a 1031 program, and we will even be able to defer your gains. So there are sort of some pretty attractive advantages to be in the real estate space. Again, for reasons discussed. So going forward here, what do we invest in? We invest in conventional rental apartments. I'm sure we've all had experience in rentals. Garden apartments, 2 to 4 story. Again, if they're newer, they'll be probably Class A. If they're repositioned, they're probably in the Class B space, and we're putting some modicum of capital into them, and we'll remanage them. Typically, service and adding to sort of today's technology is a huge boost. And we spend a fair amount of time researching what works and what doesn't. A little bit about our, just generally speaking, our returns relative to equity returns in stocks and bonds over a period of time. But again, we're not underwriting to those kind. That's great that we can show you that, but ultimately, if we can give you guys 10 to 13% returns, we're really happy about that. Over here, just in general, here's the general concentration. It's largely been moving to the southwest, southeast, mid-Atlantic. We are now building out. We have production offices in Chicago and Denver, and our plan is to grow out to the west. Ultimately, we'd like to be out here. California is a great place to own and operate. Of course, like anywhere else, it's an expensive place, and you just have to pick your markets. One of the things that we like about what we're doing here is we're very sub-market specific. We like certain parts of Tampa, we don't like others. We like certain parts of Birmingham, Alabama, we don't like others. We're in Chicago, but we're not in downtown Chicago. We're in Schaumburg, we're in Itasca, we're in areas where the jobs are self-sustaining, where there's a story that's very local. When you're in the rental business, you want to be close to your story. Is your story good schools? Is your story good jobs? Is your story something else? People will drive 2 hours from where they own, I think out here more, to their job. But in the rental space, you want to be close to what you're targeting. So maybe a half an hour. The average renter probably drives half an hour from where we own to get to their jobs. Okay, so one of the things I want to make sure we spend some time on kind of running out here is how do we access? So how do we do business? We do business with high net worth investors, and we do it generally with you as an LP, and you get to pick deal by deal. We have the ability to have you invest through portfolios of funds if you choose to acquiesce that discretion to us. But most of our investors, we show you a deal, you can decide if you like it. And we're generally doing about 20 a year. That's what it comes down to. Whether you like core, whether you like development, you do not like Washington, D.C. Generally speaking, if you choose to, you can pick what you want. And so that's a big piece. And in these vehicles, people always have questions about liquidity. Well, we offer investors every 2 years through your investment the opportunity to raise your hand. We'll appraise the assets. If it's a liquidity event, I think maybe 1% of the folks have actually done it. If you choose to get out for whatever reason you want, we'll do our best to match you up. It's not a guarantee, but it is an option that you can have. So some folks are always concerned about liquidity. We try and give you guys the best options we can. As far as kind of getting into what do you get, we send out executive summaries, we send out PPMs. Some of these are regulated documents with the SEC. Full disclosure on market, full disclosure on investment merits, pros and cons, fees, financial analysis. So you'll get to see plenty of information with plenty of time before you have to decide. So I'd like Kevin to speak for a few minutes just about the fees and economics and how we do business with you guys, so we get that out there.
Yes, so our investment process, you get executive summaries, as Adam said, and then there's going to be an external phone call with investors who have interest in listening to the thesis of the asset, and if you have any questions. Then about 2 weeks later, we get out PPMs, and they are very detailed. I don't know if we have them. Do we have them here?
I just handed one off.
So they're very, very well detailed, and they have all the information for the investment thesis and the asset where it is. And there is a fee structure, but I just want to make clear up front that they're not front-loaded fees, and I'll explain it to you. It's for your investment that you put in, your distributions, and as Adam said, we're in different sectors, so it's conventional, it's student housing, it's development, and now senior living as well. Your distributions can be different depending upon what the asset is. But over the life of the hold, it's a 7.5% preferred. And so if you invest 100, 500, or $1 million in the space, you're not gonna pay the fees up front. Your distributions will not be affected until the back end when the asset is sold. So if you put in $100,000, you're gonna get distributions every month based on 100,000. And so to let you know what happens on the back end, when an asset is sold, there's a 7.5 pref throughout the life. So if you haven't gotten 7.5 in your distributions, that's the first thing that's a make whole, because you've been accruing the whole time between what you have been getting and the 7.5. Then you get 100% of your principal back, and then it is a split 75-25 on the ups of the asset when it's sold. 75% goes to the LPs, 25% goes to the GP. And that's where we make our money. Our fees on the line items, and I know I'm over, I'll do it in 15 seconds, Lauren. The line items are 1% asset management fee in the equity piece, 1% acquisition fee, the whole price, 1% disposition fee in the whole asset, and then a one-time 3% broker-dealer fee because we do own our own broker-dealer. But when you look at these, you can't add 3, 1, 1, 1. Over the life of the hold, the net returns on our track record that you'll see, it averages out to be about 300 basis points or 3%. And so if it was, our projections was 15%, that means it was an 18% IRR, net 15%. That's it.
Thanks. Just to close up here, in 2017, we'll raise roughly $280 million of equity capital for roughly $700 million of capitalized costs for roughly 22 deals. That 280 is a share of ours, and it's predominantly from the high net worth community, from private investors just like yourself. We have roughly 1,300 private investors that are currently doing business with us throughout the 56, 57 deals we had. I'll be happy to answer questions for you about rental housing and how we do it, but most importantly, we're appreciative of your time and welcome any questions that you may have.
Okay, great job. Any questions? Okay, I'm gonna go all the way to the back. Nice to see you. Chris, board member, real estate investor.
How much?
Hi.
7%?
What is the minimum investment?
Minimum investment?
Yeah.
Typically 100,000.
Okay. And can you do
Can
1031?
be less, but typically 100.
Can you do 1031 exchange through the investment? Okay, thank you.
We have done 1031s for internal investors when we sell projects, and occasionally we will bring in clients who have 1031 transactions outside that they would like to transfer in. A little more complicated, but it does happen.
Okay, next question. Okay, Nick?
What's going on? Property?
So, individual, you select the project you want to get in. If you don't like the project, you wait for the next one or whatever. How long do you typically hold? Does this kind of just go on and then you refinance and bring capital out that way with avoiding capital gains, and just keep the cash flow going? What typically is your hold? Is it 10-year? Is it 5-year?
Sure. First, yes, you have discretion over the investment selection. Pick whichever ones you like. We do have an option where you can acquiesce to a sort of portfolio where we make sure that portfolio invests in every deal. You just don't either want to be bothered or you would rather be in a little bit of everything. We can do that for you too. Some people choose that. Hold period, we underwrite typically roughly 7 years. We may or may not hang in there that long. Really, it's an entrepreneurial strategy. So we put long-term fixed rate debt on the acquisitions to lock out our capital markets risk. So at least we know that we've got that figured out. It's usually 7-year interest only. That takes a lot of the guesswork out of it. But if we sell sooner, we'll be happy with that. We'll analyze that. But really every year we do an annual budget, an annual projection. And if we decide through wholesale analysis, which is pretty standard, that we think that it's in everyone's best interest to sell an asset, there's maybe supply coming or something's changed in the market, we might be sellers. Otherwise, we intend to hold for cash flow. Yeah.
And then the 3%, does that come out the broker deal? Does that come out at the outset, beginning?
I'm sorry, what was your question?
Does the 3% broker dealer pay to you guys?